The bear is back. Just yesterday I was still fully on the bullish side, expecting a bounce in the S&P 500 after a 10% sell-off, a fear and greed index at extreme levels, and strong seasonality pointing towards a rally. But today, looking at the chart, things have changed completely. So I've switched to the bearish side. That's how fast things can shift in the market. Flexibility is key in trading. I was already $4,500 in profit with my long trade in the S&P 500, but after the US market opened with a down gap, I decided to give it until 10 a.m. New York time to see if buyers would step in. When they didn't, I closed my position and locked in $2,000 in profit, even though my target was missed by just 40 points. Since we are still in a broader downtrend, I decided to take my profits before the trade fully reversed or stopped me out, even though my stop loss was already in profit. Now the question is, why did I switch to the short side, and what new trade did I open? We are back on my trading screen, and here you can see the micro E-mini S&P 500 chart where I reversed my position. I was previously long, expecting the market to break out above the 5,700 level and move toward my target of 5,800 points. However, the market failed to reach my target, and today we opened with a downside gap, falling back below the previous resistance zone. The key question now is, was this a false breakout? Initially, I expected the bounce to continue further, but the bears returned faster than anticipated, so I decided to go short at 5,665 points with 6 contracts. The reasoning behind this trade is that yesterday we broke above resistance but failed to hold that level. The market then gapped down at the US Open, sold off immediately, and dropped back below 5,700. This trapped many buyers who had expected a continuation of the rally, leading to a bull trap scenario. Currently, we can also see an inverted hammer forming, meaning that every upward move is quickly sold off. This was another confirmation for me to enter a short position. I placed my stop loss just above the daily high, and I expect the downtrend to resume, potentially bringing us back toward the 5,560 level. I believe that many stop losses from trapped buyers are currently sitting around that area, which could trigger further selling pressure. Of course, this is just my interpretation of the market. We always trade based on probabilities, not certainties. Tomorrow, we also have the Federal Open Market Committee, which could add even more downside momentum to the market. But for now, based on what I'm seeing in the chart structure, I have closed my long position, switched to the short side, and will continue to trade with the trend. My second position is in crude oil. You can see both of my trades in the lower window under portfolio, along with my unrealized P&L display showing my current profit and loss. My trade idea was one that I had already attempted yesterday, targeting the resistance zone just below the $68 mark. This area has acted as a strong resistance level multiple times, once in early March, then again around March 7th, and now once more today. However, the market failed to break through this level, and when the price rejected resistance and fell back inside the zone, I decided to enter a short position. As we can see right now, the market is already selling off. My entry was at $67.67, and I placed my stop loss just above the daily high. For now, I'll let the trade run and monitor its development before deciding where to close. Ideally, I'd like to see a move down towards $65 or lower, but I'll adjust my plan depending on how the market behaves. Interestingly, I attempted the same trade yesterday, but the market gapped up overnight, hit my stop, and took me out of the position. That trade cost me $1,000, which was frustrating. My portfolio performance, as you can see, is currently moving sideways. I'm having a mix of winning trades, but I'm also giving back some profits. The issue right now is that my trades haven't quite reached their targets, which is why my account isn't making new highs at the moment. The key takeaway is that risk management is everything. As long as I keep my risk under control, the winning trades will eventually align perfectly, and I'll be able to push my account back toward all-time highs. This episode has been a great example of how flexible you need to be in trading and how important it is to constantly reassess your trades. Sometimes, you have to close a trade even if it doesn't reach your target. And just as quickly, you might find yourself completely shifting your market outlook. The key is to never hold on to opinions too tightly. Trades can go well, and they can go badly. But at the end of the day, the only thing that truly matters is managing your risk. The market can always change direction, and no one knows where it will be next week. Anyone who claims otherwise is either clueless or trying to act like a market guru. In reality, we are always just looking for good risk-reward setups, nothing more. And as we've seen in the S&P 500 today, market sentiment can change in an instant. That's just how it works. I'm excited to see how these trades develop. The crude oil short trade has already started off very well, even though I'm currently trading against both seasonal trends. Historically, March to May has shown a bullish tendency in both oil and stocks, but if we are transitioning from a bull market into a larger bear market, the statistical advantage of seasonality over the last 20 years, when markets were mostly bullish, might no longer hold up. That's why it's always crucial to stay flexible, analyze the market objectively, and most importantly, manage risk. If you enjoy this content, subscribe to the channel and let me know in the comments. Are you still bullish on stocks? Or have you, like me, switched to the short side? Also, I'd really appreciate it if you could leave a like on the video. See you in the next episode.